It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Double up. 50% tariffs on steel and aluminum kick in. Meanwhile, President Donald Trump struggles to strike a deal with his Chinese counterpart. Salt impasse. Senate Majority Leader John Thune says the president's big beautiful bill will have to change to pass his chamber. And leaders in private equity flock to Berlin for super return. Don't miss our interviews with BlackStone Vice Chairman Thomas Nides and Ares Management Co-President Blair Jacobson throughout the hour. Now let's get a look at where markets are standing as we look towards futures. We are seeing another day of potential positive gains for all the major indices. Remember, we've had two nice sessions this week with the S&P 500 up 1% so far on the week. It looks like we might have another positive one today. In terms of the Nasdaq 100, we're seeing another 0.1% in gains, at least according to futures. We have that index up 1.5% on the week, and the Russell 2000 also looks to be staying positive as the whole market really looks to the jobs report Friday. And to that event, let's take a look at bonds, because we did see a little bit of selling in bonds yesterday with a more risk-on tone. We saw a few basis points of a move higher, holding steady relatively today. That 30-year yield, though, close to that 5% again. We've been testing it all month so far, at least Monday and Tuesday, and we may test it once again today. Well, let's get a look at some individual stocks to watch now. We'll head across to London and Joe Easton. Joe.
Hey, Vonnie. So it's a big day for Wells Fargo. The company is coming out of some restrictions that were slammed on the US bank around 7 years ago, restricting its growth and potentially costing it tens of billions of dollars following several scandals at the firm. So this really boosting that stock today. We're up almost 4.1% on Wells Fargo. Keep an eye on that one as we progress. One stock not doing so well though, CrowdStrike. This one was slipping, actually extending those losses now. We're down more than 6% on CrowdStrike. We'll all remember that big shutdown on their systems back in July. I was traveling that day myself, so it's scarred on my memory. But the earnings report today pretty much just missing the top end of the buy side expectations, which were lifted headed into that report. So that stock weaker today. And then finally, to finish on another green one, this one is Hewlett Packard Enterprise. It's actually beating expectations. This is hardware, a lot of it driven by the AI hardware demand. Actually, analysts pretty pleased with that one, Vonnie, on HPE, not to be confused with HPQ, of course. And check out the Before the Bell opening wrap for a summary of all these, as usual, Vonnie.
Amazing, Joe. Thank you so much. We'll be back with you in a little bit. And coming up this hour, live from Super Return in Berlin, we'll speak to Ares Management Co-President Blair Jacobson, plus an exclusive interview with BlackStone Vice Chairman Thomas Nides. But first, President Trump's 50% tariffs on steel and aluminum imports kick in.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost. And the president saved that company, he saved those jobs, and he's saving that community.
Joining us now is Bloomberg's Brendan Murray. Brendan, thank you. We were waiting on President Trump to fulfill this promise to have 50% tariffs kick in. Indeed, he did. What is the next step in terms of challenges?
Well, the next steps in terms of challenges are to try to convince all the American trading partners that they shouldn't retaliate. Basically, this is going to really not create a great mood with countries or economies like the European Union, with South Korea, with Japan. This is only going to ratchet up the pressure and the tension in these bilateral talks that the administration is having ahead of the July 9th reciprocal tariff deadline. So it just extends the pain to exporters like Germany, and it creates an environment where if you're on the other side of if you're on the receiving end of these 50% tariffs, that's just going to create more pain in your economy. So it's going to make the goal that the administration has to reach these deals even harder to reach.
And what kind of time frame are we looking at? The USTR, Jameson Greer, is in Paris today. There's a ministerial meeting, a trade ministers meeting on the sidelines of the OECD. Is it possible that things could change very quickly?
It doesn't seem likely to change very quickly. Now, the administration would argue that a lot of these deals are coming together as planned with India, with Japan, with South Korea. They've said that these are on track to happen, not imminently, but over the next several weeks. And so we'll see what happens with Jamieson Greer, the USTR in Paris. He's going to meet with his G7 counterparts, which would include, the major U.S. trading partners in steel. So we'll have to see if we get any readouts from those closed door meetings. But it certainly sets the stage for a contentious air in the room if you've been greeted with a 50% steel tariff that was 25% yesterday.
Yeah, exactly. And Brendan, if I can move to another trade theatre now in China, we were anticipating some kind of call, and then we got this Truth Social from President Trump last night saying that Xi Jinping is, quote, very tough and extremely hard to make a deal with. It seems that tensions are increasing, if anything.
Yeah, exactly. President Trump seems to think that the one thing that he needs to do to release some of the tension between the U.S. and China is have a call with President Xi, and China is just not willing to make that happen, apparently, or at least want some major concessions for that for that call to go forward. And in the meantime, Bloomberg is reporting that China is looking at a bunch of Airbus jets to purchase. So that says to a lot of analysts that China is kind of giving the U.S. the cold shoulder and looking more favorably at Europe. So that you have to weigh that part of the calculus into the relationship dynamic here. That China is basically turning away from Trump's approach. It almost looks desperate. I believe that social media post was at 2 a.m. last night. So apparently he's losing sleep over it, and it's only going to make the relationship between Europe potentially even and China even more stronger.
All right, Brendan, we'll see if that call ever happens between President Trump and Chinese Premier Xi Jinping. That is Brendan Murray there for us, and thank you, our trade czar. Well, over on Capitol Hill, the Senate has begun deliberations on President Trump's, quote, big, beautiful bill, and Majority Leader John Thune warns changes will have to be made to the SALT deal. For more now, let's bring in Josh Gallo. So, Josh, this SALT problem, if you want to call it that, is only one of the problems. What are the priorities for the Republican senators?
Well, that's part of the problem. The priorities are different for many of the marginal senators that they need to fall in line to pass this bill. So the SALT tax, the state and local deduction, was basically something that Trump installed in 2017 in his original program and set a cap of $10,000. The House wanted that to go up because, of course, these are states like California, New York, New Jersey have high property taxes, high property values, and they want a bigger break for their constituents. That was a critical piece of moving this legislation through the House, but in the Senate, there are far more senators concerned about the impact on the deficit. So they're less concerned about SALT because those states that really care about it are represented by Democrats, and their votes aren't really needed there. So look, fundamentally, this is a conflict over spending. The bill as it stands coming out of the House would add about more than $1.5 trillion to the deficit over 10 years. And that has a lot of fiscal hawks like Rand Paul, Mike Lee, Ron Johnson, really balking at this and looking for more cuts. But the problem is, there are a lot of other rural states that are going to suffer from those cuts, like less spending on Medicaid, for instance, in rural areas, and also states that are benefiting from credits and subsidies for clean energy, like North Carolina and others. So, there are a lot of conflicting priorities right now that it's hard to see the path forward immediately, but some people will definitely be unhappy with the result.
Yeah, and one high-profile business person, if you want to call him that, also now an opponent, Elon Musk, blasting the tax bill. He posted on X, quote, this massive, outrageous, pork-filled congressional spending bill is a disgusting abomination. Shame on those who voted for it. And also, it more than defeats all the cost savings achieved by the DOGE team at great personal cost and risk. Does Elon Musk's opinion hold sway here? Do opponents, for example, of the bill in the Senate now perhaps have just that marginal bit more momentum, Josh?
It does hold sway. You know, it depends on the senator and the issue, but honestly, you've seen what Elon Musk is willing to do in terms of weighing in on politics and spending money on getting people either pushed out or into office. So anybody who is now thinking about supporting this bill after having seen what Musk wrote has to be thinking in the back of their mind, what is he going to do when I'm up for election in the midterms next year? So this is something that's going to certainly weigh on them, and it's a very tough position for any lawmaker to be stuck between President Trump and somebody like Elon Musk.
All right, Josh, we will continue to watch the negotiations throughout the week. That is Josh Gallo. Thank you so much for joining. Now on to other top stories trending on the terminal this morning. It's a day before the ECB rate decision and President Christine Lagarde's news conference, where she's about to face scrutiny on her commitment to lead that central bank. Lagarde has been courted to lead the World Economic Forum, despite having another 2.5 years on her term at the ECB. Walmart is terminating some jobs in Florida following recent immigration rulings by the Supreme Court. According to people familiar with the matter, employees in at least 2 stores were told they will lose their jobs if they don't get new work authorizations. Walmart declined to comment. Rémy Cointreau withdrew its long-term sales guidance, blaming tariff policies in America and China and a slow recovery in the US market. The company forecasts mid-single-digit organic sales growth this year. The maker of Rémy Martin Cognac appointed a new CEO last month. Coming up, Super Return is underway in Berlin. We're live with our own Danny Berger, speaking with Ares Co-President Blair Jacobson. That's next. This is Bloomberg.
Right now, while the Tariffs and Liberation Day got a lot of the headlines, the market forces, the so-called BOD vigilantes, have woken up those to the concern about the growing deficit in the United States. So in the marketplace right now, with a little bit slower growth and some concern, a lot of hand-wringing, the deficit issue has taken the main stage versus the impact of the tariffs. Now, this administration, we can't get too comfortable. There can be a headline in the next few minutes to change that. But right now, the big focus is on rates and the deficit, obviously, as the current administration is focusing on their big, beautiful bill.
Apollo President Jim Zelter there speaking to Bloomberg as the private credit world gathers in Berlin for Super Return. Let's head over there now to Danny Berger at the summit. Danny.
Bonnie, thank you so much. You're right. That is the topic of conversation, and I'm pleased to say that joining us is an excellent guest. It is Blair Jacobson, co-president of Ares Asset Management. Blair, thank you so much for joining this morning.
Great to be here, Danny.
Fantastic to see you in Berlin. And look, it's been half a year that's, let's be honest, has felt like a decade. It's also half a year in which you were elevated to co-president, so you have a more holistic view of the business. In this moment of volatility, just how challenged are corporate business models for funding and liquidity right now?
So we're clearly in an interesting moment. We came into this very, very well positioned. You know, our company's book is roughly 70% credit, 90% of that senior secured. Earnings did very well in 24 and into Q1 25. Clearly, this is the year where we see the results of politics. A lot of twists and turns, but when we think about how the businesses are performing, we're more focused on the mid-market, so our company's a little bit more local focused and international trade focused. They're also in sectors which tend to be a bit more resilient, less manufacturing, a bit more services. But we're still getting the numbers in for April and May, and we'll see, but so far we haven't seen any real negative KPIs or liquidity signals that would lead us to be overly concerned around business activity.
Is there anywhere that there's stress? I mean, there's got to be, right? Things are so upended. You feel it certainly in public markets. Is that nowhere in private markets?
I think what does make us nervous, what we're monitoring very, very closely, are the derivative effects. Even if you don't have tariff-impacted businesses, certainly all of the dislocation in the markets would make a CEO hesitant around new business decisions, CapEx decisions, growth decisions. So we're very focused on CEO confidence. It also goes into consumer confidence. Consumer, big force in the economy, thinking about how they're allocating their spending, especially because it's very discretionary. So I'd say those are the two areas that we're really focused on from a risk perspective.
And any signs of any stress there yet?
Not yet, but we're monitoring it very carefully.
Well, elsewhere, there has been deal volumes that have really started to plummet. M&A is on the back burner at this moment. Banks are also still competing at a moment where private credit has raised a lot of capital. Ares itself, a lot of dry powder. You mentioned 70% credit. Does that mean that more money is chasing fewer deals? Is that a problem for this industry right now?
Good question. I feel like this comes up every couple of years. You're right. We feel great. We have 140 billion of dry powder, record for the firm. And the question is, how would we invest that? If you go micro, look at Europe. We talk to something like 1,400 companies every year. We only make new loans to between 30 and 50 companies. So again, we're very selective. There's a lot more going on in the markets. Also, if you look at the dry powder of private equity versus credit's maybe 15 to 25% of that. So again, as long as there's confidence, in particular in the mid-market, private equity needs exits, their LPs need DPI. So even though things have slowed a little bit, still active on the M&A side, but also very active on the refinancing side and the industry consolidation.
Do you think others are being less selective, though, with all that money that needs to be put to work?
I'd say potentially. Again, we don't comment on what our competitors do every day. I think we're more focused on what we're doing. And again, this is a market where due diligence, credit discipline, documentation discipline is especially important.
Very diplomatically answered, Blair. I appreciate that. But within this era of competition, the banks are still big players. In fact, we see a lot of deals where borrowers are trending more towards banks in prior periods of dislocation when private credit was really their only option. Has that surprised you?
Not really. I think that private credit, the foundation has always been in the mid-market where commercial banks are less active. When you think about bigger companies, they've always accessed the capital markets. It's very efficient. I think the interesting thing today is when you see what happened in 2022 and 23, when the capital markets were closed for a long time, private credit came in and financed a lot of these businesses. So companies and their owners now know that they have options. This is really advantageous for us. Bloomberg reported on a really big loan we just signed in the US. We're working on similarly sized loans here in Europe that are big and companies that could access the capital markets, but at the same time find private capital more compelling.
Well, the other big change that maybe is starting to be underway for this industry is the so-called convergence of public and private. And part of the way that's taking shape, Apollo, our reporting suggests that they're opening up a trading desk, trying to get more liquidity into the asset class. But this is an asset class that one of its benefits had been low volatility. So is it an issue if it starts to trade more and there's more mark-to-market and more volatility?
So I think our view on that is public-private convergence is happening. We first saw that in the loan space, again, as I just mentioned, with larger companies. The next question that's been brought up is, will private credit ever trade? I think we take a bit of a skeptical view on that. Private loans are private for a reason. Their owners want it private for a reason. They tend to be smaller companies, more concentrated holdings. And in fact, in some of those documentation provisions, you're actually prohibited in some ways from trading. So might things move around a little bit? Perhaps more stress names potentially, but does it become big? I think we have to wait and see on that.
So just structurally, the mechanism isn't there, from what I'm understanding, to get more widely traded.
It's a challenge.
Okay, it's a challenge, but part of the reason, presumably, funds like Apollo are trying to do this, is because they want the liquidity to package up into more retail-type wealth management products. I know it's something Ares has been very active in, wealth management, but if the industry as a whole is pushing to retail, the criticism is they're packaging up the worst stuff and selling it off to retail. Is that a real risk?
I think for us, retail's been part of our DNA for 20 years. Started really with our first loan vehicle in the US, which was a publicly traded BDC, which has gone through all types of different macro environments, micro environments. When we think about the loans that go into those vehicles, it's the exact same loans that our institutional clients get. That's how we allocate them. So again, I don't view that at all as a negative.
We have seen some of your peers team up with more retail type companies. So you have KKR and Capital Group, BlackStone with Vanguard and Wellington. Would Ares ever do one of these partnerships?
We're always exploring those partnerships. Certainly from our perspective, again, around a quarter of what the firm does touches retail in some way, shape, or form. That's not only in publicly traded vehicles, increasingly that's on the wealth side. I think with any partnership, you have to explore the benefits for both sides. I say currently we're doing fine with what we have, but we're always looking at additional opportunities.
What's sort of the precipice in when you say, okay, we need to bring a partner on, that we don't want to just go at this alone? What is that line in the sand?
I think what we always are mindful of is accessing different distribution channels that perhaps would be a challenge for ourselves and our existing team. We're obviously very mindful that a lot of these companies, for example, there's discussion in the U.S. About allowing 401ks to invest in private markets more, and some of those businesses that you mentioned have very good lines of sight into those clients. That's something we're monitoring closely as well.
It's interesting because in some ways hedge funds underwent this stress. When all of a sudden ETFs became really popular, one of the things it did was it brought fees down, because all of a sudden you're competing with these retail products that have lower fees. Could that possibly be the destination for this industry? Could fee models be challenged if all of a sudden you have cheaper retail products out there?
So I think the way we think about it is, broadly speaking, the fee model needs to match the risk-adjusted return of the underlying asset. In particular, private assets are hard to originate. We have hundreds of people all over the world seeking unique assets for our clients, and again, that demonstrates a certain fee level that our institutional clients pay and our retail clients pay. Do people always want to pay less for more? Of course they do. But again, we think that that's under a good trajectory.
Well, it's part of the hard work you do, and why we're so pleased to have you now as co-president of Ares. Blair, thank you so much for joining. We really, really appreciate your time. I know there's limited amount at this conference, so you're very generous. Bonnie, with that, I'll hand it back to you. That is, of course, Blair Jacobson of Ares.
Fantastic interview, Danny, and we will be back with Danny Berger at Super Return later on in the hour. Time now for our front page news, a look at what's making headlines around the world. First up, the Wall Street Journal leads with how 4 major automakers are racing to find a workaround to China's stranglehold on rare earth magnets. According to people familiar with the matter, makers of traditional vehicles and EVs are considering shifting some auto parts manufacturing to China to avoid factory shutdowns. Next, on the Financial Times front page, Germany's plans for corporate tax breaks. The package of incentives will cost €46 billion in total by 2029. It's looking to pass the package over the summer in an effort to jolt the country out of stagnancy. And the Washington Post reporting on ICE, saying they had taken into custody the family of the man accused of injuring at least a dozen people in Boulder, Colorado. Homeland Security Secretary Kristi Noem said the agency was investigating whether the family knew and provided support for the attack. Well, let's get a check on the markets now as we head into the Wednesday session. In just a few hours, we'll see the open in New York City. Right now, S&P futures are still pointed higher to the tune of 0.2%. That would be a third day of gains if this continues. The S&P, of course, rose 0.6% yesterday. It's up 1% on the week so far. And another thing to point out, the regular S&P outperforming the equal weighted index now year to date, and that's the first time since just after the February record. The dollar index continues lower, down more than another 0.1%. That's continuing weakness for the US dollar index. And we did see some buying in treasuries to start off the week. A little risk on tone as we look towards potentially a better labour market report. So far, the labour market data this week has been pretty sanguine. We'll get ADP later on today. If you look at the euro, we're trading just a little stronger. And the same for sterling off the back of that weaker US dollar index. And in terms of treasuries, we may test the 5% mark again today on the 30-year yield. We'll have to see, but we have been testing it quite frequently, but not breaching it, at least in terms of a closing level. Coming up, trade tensions mounting between Washington and Beijing. President Trump says President Xi is extremely hard to make a deal with. More on that next. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Double up, 50% tariffs on steel and aluminum kick in. Meanwhile, President Trump struggles to strike a deal with his Chinese counterpart. Salt impasse. Senate Majority Leader John Thune says the president's big, beautiful bill will have to change to pass his chamber. And leaders in private equity flock to Berlin for super return. Don't miss our interviews with BlackStone Vice Chairman Thomas Nides and Ares Management Co-President Blair Jacobson throughout this hour. Let's take a look at how we're shaping up for the Wednesday session. Looks to be another green one. That would make 3 this week if it holds. S&P futures pointed higher to the tune of 0.2%. We have a gain so far this week for the S&P of a whole 1% after 2 positive sessions. It's looking similar for the Nasdaq 100. That index is actually up 1.5% on the week so far. And the Russell 2000 also positive to the tune of 0.4%. Markets, it seems, looking towards the jobs report Friday, and so far the labour market data this week has been good. That's prompted some selling in treasuries too. You see the 2-year yield back up to close on 3.96, the 10-year at 4.46, and that 30-year yield very close to 4.99. May it test the 5% mark today? Potentially, but will it close above that level? Unlikely. We've seen it test that level and breach it intraday several times over the last several weeks. Well, let's look to some stocks to watch now individually. Here's Joe Easton. Joe.
Hey, Vonnie. So CrowdStrike really the one that is suffering in the pre-market at the moment. We're down more than 7% on the cyber security company, actually only missing expectations by a very small amount in terms of the guidance for the year. But that stock had rallied around 40% over the past few months into the report. Now, we all remember, of course, that big shutdown of their system in July. I was travelling myself, stuck in Stansted Airport in a queue specifically. They are recovering from that, according to their guidance, with the stock down once again. Then we've also got Wells Fargo, a big day for that company. They are released from some restrictions that were imposed on the firm around 7 years ago due to concern around their growth, and following a couple of scandals. That stock gaining around 3.6%, losing my vision on that one today. Wells Fargo boosted by that news from the Federal Reserve. Then another stock gaining, HPE, that's HP Enterprises stock, up 5.2% today, beating expectations on their AI data storage hardware, according to analysts. That stock continuing to pair a recent decline, so HPE, another one moving in the pre-market today, Vonnie.
Brilliant, Joe. Thank you so much. That is Joe Easton there. Well, back to our headline story. President Trump's doubled steel and aluminum tariffs of 50% take effect.
This is a president who doesn't just talk the talk, he walks the walk too, and he's delivering on his promises to bolster our steel and aluminum industries in this country and to protect those jobs. If not for this president, that steel plant in Pittsburgh, Pennsylvania would have closed. Those jobs would have been lost, and the president saved that company, he saved those jobs, and he's saving that community.
Joining us now is Bloomberg's Brendan Murray. So President Trump did follow through. He did sign the order doubling the tariffs. What have we heard from countries that are affected by this now with us, Brendan?
Well, the message from a lot of these countries is that this is going to make the bilateral trade deals that Trump is trying to strike with them harder to reach. This is going to inflict much more pain on their steel makers. We had an Austrian steel maker today saying that this really clouds their outlook. So this is going to make the Europeans even more difficult to strike a deal with. The Japanese will not be happy with this. Remember, they also have auto tariffs on their exports to the U.S., South Korea as well. So this is really going to complicate the Trump administration's goal of striking these trade deals. Now, the UK got a 5-week reprieve based on the deal that they struck a few weeks ago. So, and Mexico, which is also looking for some sort of reprieve from Trump's 50% tariffs on steel. So we're seeing a number of countries around the world really frown on what the president has done. Of course, the president would say this is protecting our national security interest in the steel and aluminum industries. So there's a bit of a trade-off here that the administration is playing, and we'll see how it plays out in the ultimate goal of trying to get a lot of these bilateral trade agreements before the July 9th deadline.
And then, Brendan, when it comes to China, we started out the week thinking that it was very possible there might be a call between President Trump and Chinese Premier Xi Jinping. But in fact, what we got last night on Truth Social was President Trump saying that Xi Jinping is, quote, a very tough and extremely hard to deal with character. It seems like, you know, tensions might actually be increasing, and it's a lot less likely, it would seem to me, that we'll get that call, at least this week.
Yeah, that's the way it would seem. Of course, anything can happen, right? You could read that social media post as a bit of flattery, saying, "Wow, he's really difficult to deal with." But most analysts that we're talking to say this is really a sign of President Trump's urgency to get on the phone. President Trump thinks that is the way to unlock the impasse that they're at with China. But China is sending signals that is not the way to deal with them. They want some concessions. There are 30% U.S. tariffs on Chinese imports at the moment. That's putting a lot of hurt on the Chinese manufacturing industry, which some numbers we've seen this week show that it's being hurt by the trade war. So we're really at a standoff right now where President Xi is denying President Trump the phone call that he so wants to show that he is the deal-making president that he was elected to be, but that's not happening. And as you suggested, a lot of people think that it's not imminent by any means.
All right, our thanks to you, Brendan Murray. And just on that, we're getting a headline crossing the Bloomberg from Margo Sevkovich saying that trade talks with the US are going in the right direction and at pace, commenting on, of course, a post on X. And this is the EU trade chief, Maros Sevkovich. Jameson Greer is actually on the sidelines of the OECD in Paris right now, and so we'll see if anything comes out of that. But moving to Capitol Hill, Majority Leader John Thune's office says the SALT deal in the House agreed to there may have to change in order for it to pass the Senate. Joining us now is Bloomberg's Josh Gallo, and it seems this is one of the sticking points, one of many, but it's one that Republicans seem to be, deciding that it's their hill to die on. What's going to happen in terms of negotiations this week to advance this bill, Josh?
Well, it sounds like there's going to have to be some kind of compromise on the state and local tax deduction, the SALT deduction, because this was a main point coming out of the House. It may not have passed if they had not raised the cap on that. It was set at $10,000, and it's been in the House bill. It moved up to $40,000 that you're able to deduct from your federal taxes. But there are so many concerns about the amount that this bill is going to add to the deficit that people in the Senate are really balking at the SALT cap, and they want to push it back down. Senator Thune, as you said, has sent a really clear signal now that there's going to have to be a compromise, and we can expect that it won't stay at $40,000 when it comes out of the Senate, but it's going to have to come down because they're looking for revenue to cover all these cuts that they're making. That, of course, would eat into it. The SALT deduction eats into that. And meanwhile, you have other camps that are pushing for not getting rid of the clean energy subsidies that have been in place under the Inflation Reduction Act, because that's supporting a lot of wind, solar businesses in their states that will otherwise not be able to compete or stay in business. So it's really getting down, again, it's down to the plus and minus columns here in terms of what the costs are. And we can expect, though, that there's going to be a change in the state and local tax deduction. Not sure how that'll go over in the House.
Yeah, and as you say, a sharp split among Conservatives, but also outside of the Senate, we're getting opponents too, including Elon Musk. He posted this on Twitter last night that the Trump tax and spending bill was a disgusting abomination, and he also said that it was pork-filled. Does this give any more momentum to the opponents of the bill, Josh? Does it hold sway?
It does, more with some than others, but of course, Elon Musk has become a very loud and powerful political voice, and he has signaled in his social media post about this bill that he is ready to go after people who vote in favor of this if they do. So, in midterm elections next year, you can expect that he is ready to spend money in their districts, and they don't want to have to go up against that kind of political force. He's willing to throw millions into these races. So, that puts these lawmakers in a very difficult position of going against the desire of Elon Musk or President Trump.
Josh, thank you so much. We appreciate your time this morning. That is Josh Gallo for us. Coming up, we're going to be taking you back to Super Return in Berlin. This time an exclusive interview with BlackStone Vice Chairman Thomas Nides. That's next. This is Bloomberg.
monitoring very, very closely are the derivative effects. Even if you don't have tariff-impacted businesses, certainly all of the dislocation in the markets would make a CEO hesitant around new business decisions, CapEx decisions, growth decisions. So we're very focused on CEO confidence. It also goes into consumer confidence. Consumer, big force in the economy, thinking about how they're allocating their spending, especially because it's very discretionary. So I say those are the two areas that we're really focused on from a risk perspective.
Ares Management President Blair Jacobson there speaking to Bloomberg's Danny Berger earlier this hour. So let's go back now to the Super Return Conference in Berlin with Danny Berger. She's standing by with an exclusive interview. Danny.
Bonnie, thank you so much. I'm so pleased to say that joining me now is Tom Nides, the BlackStone Vice Chair, who also previously served as the ambassador to Israel, along with many other government and private sector roles. Tom, thank you so much for joining this morning.
I'm honored to be here.
It's really great to see you, also just because of the wealth of background you bring, that we can get into more than just private equity, which I think is a relief for many here. But we are in this moment where there are a lot of global conflicts going on right now, and global conflicts that when this administration came in, very forcefully said, we want to bring an end to, and we're going to speed that up. It hasn't yet happened. Is America's sphere of influence, has it diminished? Is it still as strong as it once was?
Well, first of all, thank you for having me. It's great to be here in Berlin. Listen, as we all both know, the world is a complicated place, and President Trump realizes, as he did in his first term, things don't turn out right away. So it takes a little time, a little energy, and I'm confident over time between the Russia-Ukraine issues, the Middle East issues, our relationship with China. Over time, the administration will get our sea legs. But America's influence is America's influence. It's about working with our neighbors in NATO, in not only in Europe, in Asia, around the world. It's creating a sense of community, and which is why it's important. That's why I'm here. That's why I'm in Berlin. Look around here. This has brought the world together for this conference.
It's true, but I mean, we are in Europe. That's brought somewhere together. The things you say about building community, you could argue that that's been challenged by this administration this year.
Listen, again, we know President Trump. President Trump has a negotiating style that some people like and some people don't. But at the end of the day, our resolve to work together as a community in NATO, Europe. Certainly from BlackStone's perspective, this is a really important region for us. In our view, we'll work together as we see all these challenges. And there's a lot of challenges. The world is a complicated place, but as we see each one of these issues, we'll talk about them and try to get through them.
They are quite complicated. We have seen in Israel, Benjamin Netanyahu, the prime minister, saying that the operations they're doing in Gaza are in order to bring an end to this war. Is it realistic that we could soon be facing an end to the conflict?
God, I hope so. Listen, I talk to the hostage families almost every week. Hamas needs to give the hostages back, okay? Number one. They need to put down their arms, absolutely. Number two, Israel needs to do a better job on the humanitarian crisis. I've said it over and over and over again. We can feed people, and we can get rid of Hamas at the same time. And yes, the war needs to end. It's not good for Israel. It's not good for the Middle East. But we need to get this resolved. But most importantly, we need to get these hostages home. And we need to continue feeding people. Innocent Gazans need to be fed.
Well, I know at the start of the year you penned an op-ed saying that the number one goal, the number one thing needs to be that concentration on hostages. Of course, the humanitarian effort important too. Has this administration done enough work to help speed that up when it comes to Israel? I know President Trump also was very clear when he came into office that the hostages needed to be brought home or there would be hell to pay.
Listen, Steve Witkoff actually I guess maybe in December, right before the Biden administration ended its term, stepped in, even though he didn't have to help release probably another 15 to 18 hostages. So I give him credit for that, and the Trump administration credit for that, even before they even assumed office, the inauguration. That said, there are more hostages. There are more bodies of kids sitting in Gaza that need to be returned. So obviously, the Trump administration, Bibi Netanyahu, but most importantly, let us not forget, it's Hamas's responsibility to give these people back. And they took them in the first place. They kidnapped people in the first place. But as I like to say, our goal as a country is to do everything we can to eliminate the threat of Hamas, but most importantly, bring these hostages home.
Along with your wealth of experience, you also sat in USTR. The administration has a lot on their plate, a lot of trade negotiations to be done, a lot of deadlines coming up. How realistic do you think it is for them to achieve these types of deals?
Well, as John Gray, who's the president of BlackStone, likes to say, we're in the midst of tariff diplomacy. And tariff diplomacy is difficult. You're right, I was at USTR. These trade agreements can't happen overnight. You can announce frameworks, as the president has done in London. But as you know, these are detail by detail negotiations. It's like you look at my tie and you have to decide, well, you can't just put a tariff on the tie. It's the thread inside the tie. So each line of each negotiation. So as President Trump knows and understands, these are going to be complicated. So my hope is over the next few months, and quite frankly, maybe over the next year or so, that they will get these trade agreements resolved. But it's going to be tough and difficult, but we'll get through it, and that's why it's called, tariff diplomacy.
Tom, that sounds like more uncertainty, and as you know better than me, business hates uncertainty. What does that mean for BlackStone and the many, many companies you work with who have to navigate, again, maybe even a year where we don't necessarily get those deals in hand?
It's interesting. We're in a unique place. BlackStone is a unique place. I mean, again, I've only been at BlackStone for a year and a half, so I can brag about it without feeling like I'm an egomaniac. But we're a unique place. First of all, we have an enormous amount of capital. So in a time of uncertainty where people, obviously the capital markets aren't robust right now, so they come to us to look for the ability to invest. So between our private credit business, our infrastructure business, our core private equity business, we're very much open for business, and we've done a really good job both in Europe. We have a massive business here in Europe. We have a massive business in this neighborhood, importantly so. And so from our perspective, the uncertainty, although it is uncertain, is beneficial to how we think about our investment thesis. And remember, we're investing for the long term. We're not really, yes, are we aware of what's going on in the next 3 months or 6 months? Of course we are. But we're investing for the next 5 and 10 years, and our clients are doing so as well. So yes, it is uncertain, but we seem to be able to thrive during this uncertainty.
You could argue, though, that we're going under a structural change that will impact the next 5 years, that global business is being rewired, that the lines of trade that were usually open are getting challenged by what we're seeing from the Trump administration. Does this industry that really thrived off of the idea you grow a business and you grow it internationally, does that business model also come under strain?
It's interesting. You look at that, so you say, okay, we have a massive infrastructure business, okay? We've talked about our data center, our port business, our energy business. Those businesses aren't going away. Those businesses aren't going away because of tariffs. AI isn't going away. In fact, it's only expanding. Healthcare isn't going away. It's only expanding. We have a massive healthcare life science business. So you have to innovate. One of the things that Steve Schwarzman and John Gray and the leadership of BlackStone has done, you got to keep innovating every day. Got to come up with new products. You got to have new ways of going to market. You have to think about it, and that's what I think why this firm is. I'm actually leaving on Monday to go to London to celebrate our 40th anniversary in our offices in the UK. You have to innovate. You have to think about what a good neighborhood is, and you got to invest in those neighborhoods.
You mentioned AI, and I know that this is an area that you, like so many others, are also investing in. I wonder what you make of the Anthropic CEO telling Axios that he thinks 50% of white-collar jobs are going to be wiped out in the next 3 to 5 years. Of course, that is something that would affect BlackStone heavily, considering the talent pipeline that comes in. Do you think that's actually a realistic change that might happen?
I don't know. I think some could have argued that the intervention of the internet had also a massive impact, and it did. It will, and there's no question about it. You and I are living this right now. How we're going to have to, people are going to have to rethink their training, think about new jobs. Listen, I have a 30-year-old and a 27-year-old. I know you're thinking you're so young to have such old children, but I know you were thinking that. And I think the reality of this is, I think, innovation, people will have to innovate, they'll have to think about new skill sets. So I can't tell you what's going to look like 5 years from now, but AI is not going anywhere. That's why we made a bet, 5 years ago when we bought a company called QTS and then ultimately AirTrunk. We believe the innovation is going to continue, and that decision was made because of the importance of the phone and the computing power. You can imagine the needs of this as going forward. So yes, it's definitely going to be a challenge, and people are going to have to think about their education and think about what their futures are.
Well, we're going to have to leave it on that question mark. Hopefully next time we talk, it's me interviewing you and not an AI chatbot.
I only hope so, okay?
Tom, thank you so much for joining. Really appreciate your time this morning. Bonnie, that is, of course, Tom Nides of BlackStone.
Danny Berger there at Super Return in Berlin. Fantastic interview, and thank you so much. Coming up, we'll get you set up for your trading day with Fed speak and lots more earnings on deck. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now let's take a look at what's ahead today. Another jobs data point coming your way with ADP employment. That's at 8:15 Eastern, of course, ahead of the all-important jobs report tomorrow. Then Atlanta Fed President Raphael Bostic and Fed Governor Lisa Cook moderate a roundtable at 8:30 a.m. Eastern. And then we also get ISM services data out at 10 a.m. Eastern, so plenty of economic data points. And some micro movers, CrowdStrike extending post-earnings losses on underwhelming sales forecasts. HP Enterprise higher in early trading after earnings beat expectations. And Wells Fargo also rising as the Fed lifts the asset cap that restricted its size for more than 7 years. That's it for Bloomberg Brief. Surveillance is next. This is Bloomberg.